Welcome to Finance Frontier, the podcast where we explore the most pivotal shifts in the financial world. Today, Sophia and I are standing in front of a building that is not just an architectural marvel, but also the very heart of U.S. economic policymaking, the Marriner S. Eccles Federal Reserve Board building in Washington, D.C. This iconic structure, completed in 1937 and designed by the renowned architect Paul-Philippe Cret, stands as a symbol of stability, authority, and the enduring strength of the U.S. economy.
Exactly, Max. The Federal Reserve Building isn't just another government edifice. It's the epicenter of decisions that impact every corner of the global financial landscape. As we stand before its grand limestone facade, marked by imposing neoclassical columns, we can't help but feel the weight of history. These columns have witnessed countless pivotal decisions that have not only shaped the U.S. financial landscape, but have also sent ripples across global markets.
That's right, Sophia. The architecture itself is steeped in symbolism. The grandiose design is meant to convey the authority and stability that the Federal Reserve represents. Walking up the steps, you are greeted by an air of gravitas. Every inch of this building reflects the monumental decisions that have been made here, decisions that have guided the U.S. economy through wars, recessions, and financial crises.
Inside, the building continues to impress with its grand design. The polished marble floors, the towering ceilings, and the intricate details in the architecture all contribute to a sense of gravitas. The lobby sets the tone for the important work that takes place here, with its elegant simplicity that underscores the seriousness of the decisions made within these walls.
As you walk through the corridors, you can almost hear the echoes of past deliberations, debates on how to pull the nation out of the Great Depression, decisions that steered the U.S. through the stagflation of the 1970s, and more recently, the intense discussions that shaped the response to the 2008 financial crisis. And it's from this very location that we'll be diving deep into how the decisions made here at the Federal Reserve are influencing the current financial environment.
In this episode, we'll be discussing some of the most pressing concerns in today's markets. We'll start with the U.S. Federal Reserve and the increasing pressure it faces to cut interest rates amidst slowing economic growth and stubborn inflation. We'll also look at the implications of recent job reports that reveal the U.S. economy may not be as strong as we thought, with revisions indicating 818,000 fewer jobs than previously reported.
Additionally, we'll examine the growing concerns about U.S. market overvaluation, where indicators like the Shiller P/E ratio and the Buffett Indicator are flashing warning signs. These signals could be pointing to a significant market correction on the horizon, and we'll discuss what this could mean for investors.
We'll also explore why now might be the right time to look at alternative opportunities, particularly in emerging markets like Brazil. With U.S. equities facing potential headwinds, Brazilian equities are gaining attention as a strategic alternative. By the end of this episode, you'll have a clearer understanding of how these dynamics could impact your investment strategies, and why diversification is more important now than ever.
Before we dive in, if you find value in our discussions, don't forget to subscribe to Finance Frontier, share this episode, and connect with us on social media. Your support helps us continue to bring you in-depth analysis and insights every week. Now that we've set the stage, let's dive into some of the most significant news stories shaping the financial landscape today. These developments are critical for understanding the broader market context and how they might influence your investment decisions.
Absolutely. One of the major headlines right now is the U.S. Federal Reserve facing growing pressure to cut interest rates. This comes after the latest job report revealed a startling revision: 818,000 fewer jobs than previously reported. This revision has shaken confidence in the labor market, which has been a key pillar of economic stability.
The labor market has been seen as a strong foundation, but these revisions suggest that the economy might not be as robust as we thought. This has led to increased speculation about potential rate cuts from the Fed, a move that could have significant implications not just for the U.S., but for global markets as well.
And speaking of global markets, there's growing concern about overvaluation in the U.S. stock market. The Shiller P/E ratio, now close to 36, has climbed to levels we haven't seen since the dot-com bubble. The Buffett Indicator is nearly 196%. Historically, when these indicators reach such high levels, market corrections have often followed, causing investors to seek safer alternatives.
Exactly. Many investors are turning their attention to emerging markets, particularly Brazil. Brazilian equities, with P/E ratios ranging from 8 to 11, offer a compelling alternative to the overvalued U.S. market. With ongoing economic reforms and new tax incentives, Brazil is becoming an increasingly attractive destination for international investors.
That's a significant shift. Brazil's relatively low valuations, coupled with the country's strategic reforms, are drawing in global investors who are looking for growth opportunities outside the U.S. This trend is something we'll be exploring further as we continue our discussion today.
Meanwhile, the global supply chain disruptions are still making headlines. These disruptions are leading to increased costs and delays, which are fueling inflationary pressures around the world. This is particularly challenging for emerging markets that rely heavily on global trade.
And we can't overlook the recent volatility in oil prices. Last week, we saw another spike, which is contributing to global inflation concerns. These fluctuations in oil prices are affecting everything from transportation to consumer goods, impacting both developed and emerging markets alike.
China's economic slowdown is also a major concern. With growth slowing down, there are fears about the broader impact on global trade. Countries like Brazil, which are major exporters to China, could see significant effects on their economies.
And in Europe, inflation has recently dropped to 2.2%, the lowest level in 3 years. This decline is significant, as it opens the door for the European Central Bank to consider cutting interest rates. After a period of raising rates to combat high inflation, the ECB is now in a position where they might shift towards supporting economic growth through rate cuts. This development is adding a new layer of complexity to the global financial markets.
Finally, in the tech sector, Nvidia continues to dominate, particularly in the AI space. Their recent earnings report exceeded expectations, largely driven by the growing demand for AI and machine learning technologies. This is a trend that's likely to continue, and it's one that investors are watching closely as technology plays an increasingly significant role in market performance.
These are all critical issues to watch as they have the potential to shape the markets in the coming months. As we move forward in today's episode, we'll dive deeper into these stories and explore how they intersect with broader investment strategies.
Now that we've covered the latest news, let's take a deeper dive into one of the most intriguing opportunities emerging in today's market environment: Brazilian equities. With the U.S. stock market showing signs of overvaluation and potential volatility on the horizon, investors are increasingly looking for alternatives. Brazilian equities, with their lower valuations and favorable economic outlook, are becoming an attractive option.
That's right. Brazil is often overlooked, but its market offers compelling opportunities, especially in the current climate. The price-to-earnings (P/E) ratios for Brazilian equities are notably lower than those in the U.S., ranging from 8 to 11, compared to the Shiller P/E ratio of around 36 in the U.S. This disparity suggests that Brazilian stocks may offer better value and less downside risk, particularly if the U.S. market faces a correction.
The attractiveness of Brazilian equities isn't just about their current valuation. Brazil has been making significant strides in economic reforms, which are bolstering investor confidence. Recent tax incentives and infrastructure investments are creating a more favorable business environment, encouraging both domestic and international investment.
Absolutely. For instance, Brazil's ongoing efforts to simplify its tax code and invest in infrastructure are expected to reduce costs for businesses and enhance profitability over the long term. This is particularly important in sectors like energy, agriculture, and finance, where Brazil has a competitive edge. These reforms are laying the groundwork for sustainable economic growth, which in turn supports the potential for stock market gains.
Another factor making Brazil attractive is its economic resilience, particularly in the face of global challenges. Despite the pressures from global inflation and supply chain disruptions, Brazil's economy has shown robust performance, supported by strong commodity exports. This resilience is crucial for investors looking to diversify their portfolios away from the U.S. and other overvalued markets.
And let's not forget the role of technology in Brazil's growth story. The country is seeing a surge in fintech innovation, with companies like Nubank leading the way. Nubank, for example, has become one of the largest digital banks in the world, revolutionizing financial services in Brazil. The success of such companies highlights the potential of Brazil's tech sector, which could be a key driver of future growth.
Moreover, Brazilian government bonds are also gaining attention. With yields significantly higher than those of U.S. Treasuries, they offer a compelling option for income-focused investors. And as inflation pressures ease globally, the real returns on these bonds are becoming increasingly attractive.
It's also worth considering the potential risks, though. Brazil's political landscape can be unpredictable, and the country is still vulnerable to fluctuations in global commodity prices. However, for investors with a higher risk tolerance, the rewards could be substantial, especially when these investments are carefully managed and diversified.
To sum up this deep dive, Brazilian equities and bonds present a unique opportunity in today's market environment. With the U.S. market facing significant overvaluation concerns, diversifying into an emerging market like Brazil could provide both growth potential and income through higher yields. However, it's essential to approach this with a balanced strategy, considering both the opportunities and the risks involved.
As we move forward, we'll continue to monitor developments in both the U.S. and Brazilian markets. In our next segment, we'll discuss some strategic insights and expert opinions on how to navigate these uncertain times and optimize your investment strategy for the long term.
Now that we've explored the potential of Brazilian equities and bonds, it's time to shift our focus to some strategic insights and expert opinions that can help you navigate today's complex market environment. With U.S. markets showing signs of overvaluation and global economic conditions constantly shifting, it's crucial to have a strategy that can adapt to these changes.
Absolutely. One of the key pieces of advice we're hearing from experts is the importance of diversification. Diversifying your investments across different asset classes and geographies is more important than ever, especially in an environment where the U.S. market seems stretched. Many financial advisors recommend a balanced approach that includes not only equities but also fixed income, commodities, and even alternative investments like real estate or private equity. This kind of diversification can help mitigate risks and provide more stable returns over time.
That's a great point. Another strategy gaining traction among experts is the barbell approach to investing. This strategy involves balancing higher-risk assets, like emerging market equities, such as those in Brazil, with lower-risk assets like bonds or cash. The idea is to maintain exposure to potential growth while protecting against downside risks. This approach is particularly relevant now, given the high valuations in the U.S. and the ongoing uncertainties around inflation and interest rates.
Speaking of interest rates, there's a growing consensus that the Federal Reserve's potential rate cuts could significantly impact investment strategies. While lower rates can help stimulate economic activity, they also mean lower returns on safer assets like U.S. Treasuries. Experts suggest that this might be an opportune time to lock in gains from growth stocks and consider rotating into value stocks or sectors like financials and energy, which typically perform well in a rising rate environment.
And when we talk about rotation, it's not just about moving between different types of stocks. Geographic rotation is also important, shifting some investments away from the U.S. and into markets that are either undervalued or poised for growth. As we've discussed, Brazil fits this profile well, offering both growth potential and relatively attractive valuations. This makes it a compelling option for those looking to diversify their portfolios globally.
Another key insight from experts is the role of fixed income in a diversified portfolio. With U.S. Treasury yields still relatively low, there might be better opportunities in international bonds, particularly in countries like Brazil where yields are higher. However, it's crucial to manage currency risk when investing in foreign bonds. Experts recommend either hedging this risk or ensuring that any potential currency fluctuations align with your broader investment goals.
Risk management is another critical aspect that experts are emphasizing, particularly in today's volatile market environment. Maintaining liquidity, keeping a portion of your portfolio in cash or cash equivalents, provides the flexibility to take advantage of buying opportunities during market corrections or downturns. It also helps mitigate the impact of sudden market shocks, which can be particularly valuable in uncertain times like these.
And let's not forget the importance of staying informed and adaptable. Markets are constantly evolving, and what works today might not be effective tomorrow. Regularly reviewing your portfolio and adjusting your strategy based on new information is crucial. This might involve rebalancing your portfolio to ensure it aligns with your risk tolerance and financial goals, or exploring new investment opportunities as they arise.
To sum up, the expert consensus is clear. In today's market environment, a flexible, diversified approach is essential. Whether it's through geographic diversification into markets like Brazil, adopting a barbell strategy, or staying liquid to capitalize on opportunities, the key is to be proactive and prepared for whatever comes next.
As we move forward, we'll continue to explore how these principles of diversification, proactive strategy, and risk management can be applied to other emerging markets and sectors. In our next segment, we'll engage with some of your questions and dive into how to implement these strategies in your own portfolios.
Now that we've covered some strategic insights and expert opinions, it's time to turn our attention to your questions. We always appreciate the engagement from our listeners, and today we've got some great questions that tie directly into the themes we've been discussing.
Our first question comes from Jason in New York. He asks, given the current overvaluation in the U.S. market, how much of my portfolio should I consider reallocating to emerging markets like Brazil? Is there a recommended percentage?
That's a great question, Jason, and one that's on the minds of many investors right now. The answer depends on several factors, including your risk tolerance, investment horizon, and overall financial goals. A common approach is to start small, perhaps allocating 5% to 10% of your portfolio to emerging markets. This allows you to gain exposure to potential growth opportunities without taking on too much risk. As you become more comfortable with the market and if conditions remain favorable, you could gradually increase your allocation.
That's right. It's also worth noting that emerging markets can be more volatile than developed markets, so it's crucial to consider your ability to withstand short-term fluctuations. If you're closer to retirement, for example, you might want to be more conservative with your allocations. On the other hand, if you're investing with a longer time horizon, you might feel more comfortable taking on a bit more risk for the potential of higher returns.
Our next question comes from Linda in Chicago, who asks, I'm interested in investing in Brazilian government bonds for the higher yields, but I'm concerned about currency risk. What strategies can I use to manage this risk?
That's an excellent question, Linda. Currency risk is indeed a significant consideration when investing in foreign bonds. One strategy to manage this risk is to use currency-hedged bond funds, which are designed to protect against fluctuations in the exchange rate. These funds can help stabilize returns in your home currency, making them a popular choice for investors looking to mitigate currency risk.
Another approach is to keep a portion of your investments in assets that tend to benefit from a stronger U.S. dollar, such as U.S. Treasuries or dollar-denominated bonds. This can provide a natural hedge against currency fluctuations. Additionally, some investors choose to accept a certain level of currency risk as part of their overall strategy, especially if they believe that the foreign currency could appreciate over time, adding an extra layer of return.
Absolutely. And for those who are more hands-on with their investments, actively managing currency exposure through tools like currency forwards or options can be an effective way to hedge against unfavorable currency movements. However, these strategies can be complex and may not be suitable for all investors, so it's important to consult with a financial advisor to determine the best approach for your specific situation.
Our final question comes from Raj in San Francisco, who asks, given the current economic uncertainties, how often should I be rebalancing my portfolio? And what indicators should I watch for to know when it's time to make adjustments?
Great question, Raj. The frequency of rebalancing your portfolio can vary depending on your investment strategy and market conditions. A common approach is to rebalance on a regular schedule, such as annually or semi-annually, to maintain your desired asset allocation. However, in times of heightened market volatility, some investors may choose to rebalance more frequently, especially if there are significant shifts in the market or in specific asset classes.
As for indicators to watch, there are several that can signal it's time to rebalance. These include significant changes in market valuations, such as the current high levels of the Buffett Indicator and Shiller P/E ratio, which suggest that the U.S. market may be overvalued. You should also keep an eye on macroeconomic indicators like interest rates, inflation, and economic growth, as these can impact the performance of different asset classes.
Additionally, monitoring your own financial situation and goals is crucial. If there's been a major change in your life, such as retirement or a change in income, it might be time to reassess and rebalance your portfolio accordingly. This ensures that your investments remain aligned with your risk tolerance and long-term objectives.
To sum up, the key to effective rebalancing is staying informed and being proactive. Regularly reviewing your portfolio and adjusting your strategy based on current market conditions and your personal financial goals will help you navigate through these uncertain times. And remember, rebalancing doesn't necessarily mean making drastic changes. It's about making sure your portfolio remains aligned with your long-term objectives.
Thanks to everyone who sent in their questions. It's always great to engage with our listeners and provide insights that can help you make informed investment decisions. In our next segment, we'll be taking a closer look at the role of technology in emerging markets and how innovations are shaping the future of finance in places like Brazil. Stay tuned.
As we continue our exploration of global markets and diversification strategies, it's important to consider the role of technology in shaping the future of finance, especially in emerging markets like Brazil. Technology isn't just a sector, it's a transformative force that's driving innovation across industries, creating new opportunities for growth and investment. In this segment, we'll take a closer look at how technological advancements are impacting financial markets and what that means for investors.
Absolutely. One of the most significant developments in Brazil is the rapid adoption of financial technology, or fintech. Brazil's fintech sector has been growing at an incredible pace, driven by a combination of factors including a large, underserved population, increasing internet penetration, and supportive government regulations. Companies like Nubank, one of the world's largest digital banks, have revolutionized the banking experience in Brazil, providing millions of people with access to financial services that were previously out of reach.
Nubank is a great example of how fintech is transforming the landscape in Brazil. Founded in 2013, Nubank quickly became a leader in the digital banking space by offering no-fee credit cards, online banking, and a seamless mobile experience. The company's success is a testament to the demand for innovative financial services in Brazil, particularly among younger consumers who are more tech-savvy and open to using digital platforms. Nubank's growth has been so rapid that it recently went public on the New York Stock Exchange, raising billions and highlighting the global interest in Brazil's tech-driven financial sector.
And it's not just Nubank. The broader fintech ecosystem in Brazil is thriving, with startups across various segments such as payments, lending, and personal finance management. According to a recent report, Brazil is now home to over 700 fintech startups, making it the largest fintech market in Latin America. This growth is being fueled by increasing smartphone adoption, which has enabled millions of Brazilians to access digital financial services for the first time.
Another area where technology is making a significant impact is in the use of blockchain and cryptocurrencies. Brazil has seen a surge in cryptocurrency adoption, with both consumers and businesses embracing digital currencies as an alternative to traditional banking. The country's regulatory environment has been relatively open to cryptocurrencies, which has encouraged innovation and investment in this space. For example, Mercado Bitcoin, one of the largest cryptocurrency exchanges in Latin America, has experienced exponential growth as more Brazilians look to diversify their investments and protect against inflation.
That's a crucial point. Inflation has been a persistent issue in Brazil, and many people are turning to cryptocurrencies as a hedge against the devaluation of the Brazilian real. This has led to increased demand for digital assets, not just as speculative investments but also as a means of preserving wealth. As a result, Brazil is emerging as a key player in the global cryptocurrency market, attracting interest from both local and international investors.
The rise of technology in Brazil isn't limited to fintech and cryptocurrencies. The country is also seeing significant advancements in other areas such as e-commerce, digital health, and agritech. Companies like PagSeguro and Payments, StoneCo and Merchant Services, and AgroSmart and Smart Farming are just a few examples of how tech innovation is driving growth across different sectors. These companies are not only creating new opportunities for investors, but are also contributing to the overall development of Brazil's economy.
Indeed, technology is playing a pivotal role in Brazil's economic transformation. For investors, this means there are numerous opportunities to tap into the growth potential of Brazilian tech companies, whether through direct investments in startups or by gaining exposure through broader market indices that include tech-heavy components. As always, it's important to do thorough research and consider both the opportunities and risks associated with investing in emerging markets.
To wrap up this segment, it's clear that technology is a driving force behind many of the changes we're seeing in Brazil's financial markets. The rapid growth of fintech, the adoption of cryptocurrencies, and advancements across sectors like e-commerce and agritech are not just reshaping Brazil's economy but are also creating new and exciting opportunities for investors. As the Brazilian tech ecosystem continues to expand, it presents a compelling case for those looking to diversify their portfolios into emerging markets.
Exactly. The momentum in Brazil's tech sector is undeniable, and the success stories we're seeing, whether it's Nubank's rise to becoming one of the largest digital banks in the world or Mercado Bitcoin's exponential growth in the cryptocurrency space, are just the tip of the iceberg. For investors, this is a moment to consider how these innovations can play a role in their broader investment strategy, particularly as traditional markets in the U.S. face challenges like overvaluation and inflation.
And it's worth noting that while the opportunities are significant, so are the risks. As with any investment in emerging markets, due diligence is key. Understanding the regulatory environment, market dynamics, and the specific challenges faced by tech companies in Brazil is crucial. However, for those willing to navigate these complexities, the rewards can be substantial.
Brazil's tech sector represents not just a growth story, but also a diversification opportunity that could help investors hedge against risks in more developed markets. As we continue to monitor developments in this space, it will be interesting to see how these companies evolve and how they might influence broader market trends. In the next segment, we'll dive into a case study that illustrates how some investors are already capitalizing on these trends and what lessons can be learned from their strategies.
To bring everything we've discussed so far into sharper focus, let's explore a real-world example of how these strategies are being successfully implemented. Our case study today revolves around an investment firm that strategically diversified its portfolio by increasing exposure to Brazilian equities and bonds over the past year. This move was driven by the firm's assessment of the U.S. market's overvaluation and the potential growth opportunities in emerging markets like Brazil.
The firm, which we'll refer to as Horizon Capital, recognized early on the challenges presented by the overvaluation in the U.S. market. With indicators like the Buffett Indicator and the Shiller P ratio signaling potential risks, Horizon Capital decided to explore alternatives that could offer better returns while also providing diversification. After thorough research, Brazil stood out as a compelling option, thanks to its relatively low valuations, ongoing economic reforms, and the growth potential in sectors like fintech, energy, and agriculture.
Horizon Capital began by reallocating a portion of its equity investments into Brazilian stocks, focusing on companies that were not only undervalued but also positioned to benefit from the country's economic reforms. They targeted sectors that were expected to grow significantly, including financial services, where companies like Nubank were making waves, and energy, where firms like Petrobras were benefiting from Brazil's natural resources.
They didn't stop with equities. Horizon Capital also saw an opportunity in Brazilian government bonds, which were offering yields far higher than what was available in the U.S. fixed income market. By carefully managing currency risk, using hedging strategies and selecting bonds with favorable terms, they were able to enhance the yield on their bond portfolio while maintaining a balanced risk profile.
The results have been impressive. Over the past year, Horizon Capital's Brazil-focused investments have outperformed their U.S. counterparts. The Brazilian equity portfolio delivered strong returns, particularly in the financial and energy sectors. Meanwhile, the bond investments provided not only high yields but also stability during periods of volatility in the U.S. market. This approach has allowed Horizon Capital to mitigate the risks associated with U.S. market overvaluation while capitalizing on the growth potential in Brazil.
What's particularly interesting about this case study is the firm's disciplined approach to diversification. Rather than making a wholesale shift away from U.S. markets, Horizon Capital gradually increased its exposure to Brazil, regularly rebalancing the portfolio to ensure it remained aligned with their broader investment goals. This disciplined strategy is a great example of how investors can adapt to changing market conditions without taking on excessive risk.
Another key takeaway from Horizon Capital's success is the importance of being proactive. The firm didn't wait for a market correction in the U.S. before making adjustments. Instead, they anticipated the potential risks and acted early. By identifying opportunities in Brazil and other emerging markets, they were able to diversify their portfolio and enhance returns, even in a challenging global environment.
This case study underscores the value of looking beyond traditional markets and considering emerging opportunities that may not yet be on everyone's radar. Brazil's economic landscape, bolstered by technology and reform, offers a unique opportunity for investors willing to explore beyond the familiar. As we've discussed throughout this episode, diversification, strategic allocation, and a willingness to adapt to new information are key to navigating today's complex financial environment.
To conclude this segment, Horizon Capital's experience highlights the importance of flexibility and foresight in investing. By embracing opportunities in emerging markets like Brazil, they were able to achieve strong returns and reduce risk, demonstrating the effectiveness of a diversified, globally focused investment strategy.
As we move forward, we'll continue to explore how these principles can be applied to other emerging markets and sectors. In our final segment, we'll wrap up with some risk management strategies you can implement to protect your portfolio in these uncertain times.
As we've discussed throughout this episode, navigating today's financial markets requires a careful balance of opportunity and risk. With U.S. markets showing signs of overvaluation and global uncertainties on the rise, it's more important than ever to have a solid risk management strategy in place. In this segment, we'll explore some of the key risk management techniques that can help protect your portfolio while still allowing you to take advantage of growth opportunities.
One of the most fundamental principles of risk management is diversification, which we've touched on in previous segments. By spreading your investments across different asset classes, sectors, and geographies, you can reduce the impact of a downturn in any single area. For example, while U.S. equities might be facing challenges due to high valuations, diversifying into emerging markets like Brazil or into fixed income assets can help balance your portfolio and reduce overall risk.
That's right. Another key strategy is maintaining liquidity. Keeping a portion of your portfolio in cash or cash equivalents provides the flexibility to take advantage of buying opportunities during market corrections or downturns. It also helps mitigate the impact of sudden market shocks, which can be particularly valuable in uncertain times like these.
Managing currency risk is also crucial, especially when investing in international assets like Brazilian equities or bonds. As we discussed earlier, using currency-hedged funds or incorporating assets that naturally hedge against currency fluctuations can help protect your returns. For more hands-on investors, tools like currency forwards or options can offer additional layers of protection.
Another important aspect of risk management is regularly reviewing and rebalancing your portfolio. Market conditions change, and your portfolio should reflect those changes. By rebalancing, you ensure that your investments remain aligned with your financial goals and risk tolerance. This might involve shifting some assets out of overvalued markets and into areas with more growth potential, like emerging markets or undervalued sectors.
And let's not forget the importance of staying informed. The financial landscape is constantly evolving, and what worked in the past might not work in the future. Keeping up with market trends, economic indicators, and global events will help you make informed decisions and adjust your strategy as needed. Whether it's monitoring inflation rates, interest rate changes, or geopolitical developments, staying informed is key to effective risk management.
To sum up, the key to successful risk management in today's market is being proactive, diversified, and informed. By spreading your investments across different asset classes and geographies, maintaining liquidity, managing currency risk, and regularly rebalancing your portfolio, you can protect your assets while still positioning yourself for growth.
As we wrap up this segment, remember that risk management isn't about avoiding risk altogether. It's about understanding and managing it in a way that aligns with your financial goals. With the right strategies in place, you can navigate the uncertainties of today's market and take advantage of the opportunities that arise.
Thanks for joining us on this episode of Finance Frontier. We hope these insights help you feel more confident in managing your portfolio through the challenges and opportunities ahead. Stay tuned for our next episode, where we'll continue to explore the latest trends and strategies in the financial world.
And as always, don't forget to subscribe, share this episode, and connect with us on social media to stay updated on the latest insights from Finance Frontier. Until next time.
As we come to the end of today's episode, let's recap some of the key points we've covered. We started by discussing the current overvaluation concerns in the U.S. market and why now might be the right time to explore alternative opportunities like Brazilian equities. We then took a deep dive into the potential of Brazil, highlighted by its relatively low valuations, ongoing economic reforms, and strong performance in sectors like fintech and energy.
We also touched on the importance of strategic diversification and risk management, especially in today's volatile market environment. Whether it's through geographic diversification, maintaining liquidity, or managing currency risk, having a solid strategy in place is crucial for navigating these uncertain times.
And let's not forget the valuable insights we gained from our listener questions earlier in the episode. Addressing your concerns helps us connect the dots between theory and practice, making sure our discussions are not just informative but also actionable.
As we wrap up this episode, remember that managing your portfolio in today's market requires both a proactive and a diversified approach. Stay informed, stay flexible, and be prepared to adapt as market conditions evolve.
Thanks for joining us on this episode of Finance Frontier. We hope these insights help you feel more confident in managing your portfolio through the challenges and opportunities ahead. Stay tuned for our next episode, where we'll continue to explore the latest trends and strategies in the financial world.
And as always, don't forget to subscribe, share this episode, and connect with us on Twitter at Finance Frontier AI to stay updated on the latest insights. Your engagement helps us bring you the most relevant content every week. Until next time. Before we sign off, we'd like to remind our listeners that the content of this podcast is for informational purposes only and does not constitute financial advice. The views and opinions expressed in this episode are those of the speakers and do not necessarily reflect the views of our affiliates or sponsors.
Please consult with a qualified financial advisor before making any investment decisions. Additionally, this episode referenced market data and news from sources including Google News and Investing.com. These sources provide valuable insights, but it's important to consider them in the context of your own financial situation and goals.
Music in this episode, including Not Without the Rest by Twin Musicom, is licensed under a Creative Commons Attribution 4.0 license. The Finance Frontier podcast name and content are copyrighted materials and may not be used without permission. We take great care in selecting the music and content for each episode to ensure it complements the information we provide and enhances your listening experience.
We also want to acknowledge the evolving nature of the financial markets. The information shared in this episode is based on current trends and data, which can change rapidly. Always stay informed and make decisions based on the most up-to-date information available.
Thank you for listening, and we look forward to bringing you more valuable content in future episodes. Stay tuned, stay informed, and continue to explore the frontiers of finance with us. All content in this episode is copyright 2024 Finance Frontier. Unauthorized use, reproduction, or distribution is prohibited without express written permission.